Well, we're not as bearish on the dollar as the market consensus. The market consensus for a while now has got euro dollar going to 120 and potentially beyond during the course of 2026. We think perhaps not. There is a lot of Fed easing priced already into the Fed. And of course, if we look at growth and we look at productivity, the US has performed very well in recent years, really since the global financial crisis. And many of those factors with respect to productivity growth and growth, GDP growth, could prove to be more resilient for the US. So we think that the dollar and its crosses could move in large choppy ranges in 2026.
What factors do you think will have the greatest impact on the US dollar? Is it really all about Fed policy, or are there other factors that could impact it in the new year?
Well, there are certainly other factors. I mean, the Fed, of course, and its policy is central to that, but also to what extent it might lose its credibility. Now, this, of course, relates to how much pressure President Trump decides to place on the Fed. There is, of course, speculation right now that Fed credibility could be lost, and that would be a very negative dollar effect. But I don't think necessarily we will get that far. Now, certainly, it is likely that some of the Fed voters next year will be dovish, and that the Fed will decide to put in dovish policy members, not least the Fed chair, in Powell's place. But at the same time, all of these people that are being considered to be part of the Fed are credible economists, and many people in the market also agree with their views. So I don't think we're going to have a significant credibility issue.
What about the 10-year yield? Because there's been this theory going around that despite efforts to pressure the Fed or to encourage the Fed to cut rates, that actually 10-year yields may not be impacted necessarily by Fed policy because they're actually determined by other factors. So what is your outlook for bond yields in the new year?
Well, bond yields and I think fiscal policy generally has become really, really interesting. And what's very interesting is some of the best performing G10 currencies this year have been those ones with the best fiscal management. So currencies like Sweden, for instance, the Swiss franc. Now, they all have very good fiscal management, low budget deficits and low levels of debt. Now, of course, the US doesn't, and this has become a bit of a theme. And there is a debate as to whether or not the fiscal management, or maybe even the mismanagement of the Federal Reserve, or rather the US budget deficit, could put pressure on US longer end yields. Again, this is going to be a debate that evolves, but we cannot get away from the fact that US Treasuries are a safe haven asset. The sheer depth and the sheer liquidity of that market means that we cannot avoid them. So I don't necessarily think we're going to get too much fallout on the US debt because of this type of concern.
Let's talk about Europe and the ECB, because it's been pretty clear from the statements we've heard from different ECB members that the door is firmly shut towards any further cuts. The easing cycle is well and truly over. Do you share that view, and what is your outlook for next year? Are we going to see a pause, or could we actually see a hike in rates in Europe?
Well, it is our central view that they have done with easing from the ECB. Now, I think the jury is still out. There are, of course, still a lot of doves in the market. We do, of course, in the next round of forecasts from the ECB, get 2028 inflation forecasts. And many of the doves out there suggest, well, look, if the 2028 CPI inflation forecast is also below 2%, as is the 2026 and 2027, there may be an argument for more interest rate cuts. That is not our view. However, there could be a downside shock, which could make that a more centralised view. For now, we think there's going to be a period of on hold for the ECB, but market rates certainly have got in a small hike for the end of next year.
We must also talk about the yen, because we're seeing more normalization from the Bank of Japan, but we're also seeing plans for massive fiscal stimulus from the new government. So which of these factors do you think will have the most impact on the yen, and what is your outlook for next year?
Well, of course, the fiscal stimulus has already been played out in JGBs, and we are seeing JGBs normalise and push higher. And we have had recent comments from the Bank of Japan or the Ministry of Finance, we don't know, this is just sources in the market, suggesting that the Bank of Japan isn't planning really to tweak its programme with respect to bond buying, meaning that it seems to be quite happy that normalisation is taking place. Now, one thing that we've got to remember for Japan is that there is a huge pool of domestic savers. They've got a big current account surplus, and that should give the yen some stability. So, for instance, in the UK, we worry a lot about the budget deficit there. We worry about the size of the UK's debt. It has a current account deficit, and that makes sterling more vulnerable. The yen shouldn't be as vulnerable to some of the concerns about the JGB market and the huge Japanese debt. However, it is interesting that the yen is one of the weakest performing G10 currencies this year, despite the fact that the BOJ is hiking interest rates. And this might be a factor that the market is quite concerned about what's going on in the longer end of the market.
Well, you mentioned the UK, and we need to talk about sterling, obviously, because it's not clear exactly the outlook on rates from the Bank of England. We're seeing a very gradual approach, and obviously we've got the very sticky inflation, but on the one hand also we've got quite low growth. So it does present a sort of conundrum for the Bank of England. So how do you think the Bank of England will be viewing these factors in the new year? And what factors do you think will be impacting the pound? Is it Bank of England policy? Is it the political turmoil that we've seen in the UK? Could political factors such as local elections, for example, also have an impact on the currency?
Well, right now, I think Bank of England interest rates are well priced in, but it is quite interesting because now, as we stand at the end of 2025, it appears only Norway at the Fed and the Bank of England are the three central banks that the market expects to carry on cutting rates through 2026. The rest are expected to maybe keep steady or maybe even hike. So it is a little bit now of an outlier. Now, the interest rate cuts are priced in, but as you said, there are headwinds to sterling, and politics will be a very interesting factor. Now, in the UK, there is, of course, a strong majority government. Now, generally speaking, that should diminish really the risk of political upset. But there is a risk here that we could have within the ruling Labour Party potentially attempts to put a new leader in, which would then, of course, mean a new Prime Minister. And that could really weaken the pound, because if we do have that type of turmoil, it is likely to be a left-leaning leader, and the markets generally do not like that.